Hello and welcome to another episode of Phillip Research in 3 minutes. I'm Wee Kuang, research analyst covering the banking and finance as well as the healthcare sectors. In today's episode, I will be discussing the attractiveness of local banking stocks currently. On the back of the current market sell-off, we can see prices of the three local banks taking a beating, with DBS and UOB falling more than the benchmark index. Faced with the triple threat of the COVID-19 pandemic, a falling interest rate, as well as possible oil price war, the profitability of banks have become suspect. However, with measures in place to mitigate the various risk factors, the fall in share price seems likely to be an overreaction as a result of fear among investors. The ongoing COVID-19 pandemic have disrupted global supply chains, causing a liquidity crunch among lenders, especially for SMEs. However, with stopgap measures by the government, impact to asset quality will likely be muted. As for the rate cuts undertaken by the Federal Reserve to combat the economic impacts of the coronavirus outbreak, we will only observe the cascading effects on NIMs in 1 to 2 quarters. Nevertheless, NIMs will come under pressure, but banks will have some time to react accordingly. The oil price war that is reminiscent of the 2016 oil price meltdown will also see muted impact on the bank's loan books, as all three banks have since taken turns to provide for bad debt within the industry and reducing exposures to the industry subsequently. Even so, upon conducting an adverse stress test by doubling expected allowances and shaving 20 basis points of forecasted NIMs, we can observe earnings deteriorate by up to 33%, which will take us to earnings level last observed in 2016. Furthermore, the recent sell-off has brought prices down so much so that the current price-to-book valuations are trading at almost 18-year lows. OCBC and UOB are currently trading at historical low price-to-book value, and DBS only saw lower levels in the 2008 financial crisis, where it was directly involved in the Lehman Brothers mini-bond saga. This means that we are actually at uncharted levels of attractiveness in terms of price-to-book valuations. Besides appealing valuations, the banks are also offering investors attractive dividend yields. All three banks increased their dividend payout in 2019, and given their current comfortable levels of CET1 ratio above the 10.5% regulation, investors are bolstered from likelihood of a dividend cut. Previous dividend cuts were only observed during the Great Financial Crisis period in 2008, and it was due to the poorer capital requirements imposed on banks then. With the buffer the banks have built up since then, the current levels of payout remain sustainable moving forward. As such, while Singapore's economic outlook starts to dim, the banks are well poised to weather the headwinds. The recent price weakness only provides an opportune time for investors to gain exposure to the banking industry while providing for an attractive dividend yield. And that's all for Phillip Research in 3 minutes today. For more information, you may view the full report on our website, stocksbnb.com, and feel free to leave a like or share with us your thoughts in the comment section below. Thank you, and we hope to see you again soon.